All right, all right. Welcome. My name is Lan Turner, and we are here at the Utah Tech University Trading Lab. And anybody's welcome, of course, but this is a university lab where we learn to trade. And if you guys want to join and learn to trade and get some trading recommendations and strategies, then this is the place to be. All right, so happy to have everybody, whether you're from the university or not. So don't feel like you can't come and hang out with us. This is a great place to hang out. We are on our summer schedule right now, so we only meet twice a week for the stocks, and then once a week for the day trading. Yesterday we had a great banner day for the day trading. If you missed that, then you should go back and watch that one. We had a really good afternoon trading power hour. We hit our goal, made our $500, and learned a little bit about trading. And tomorrow, or I mean next Wednesday, we're going to continue on with that lesson, and we're going to talk more about how to do a little bit of day trading, because it takes money to make money, and you have to be able to have a little bit of money as you got to prime the pump, a little bit of seed money there, so that you can start to grow that money. And one of the best ways to grow that is, well, I'm not going to say it's the best way to grow money through day trading, but it's a way to grow money through day trading if you can get good at it. And you start it off, it's kind of like a video game, and you just play the video game. And if you get good at it, well, you flip the switch and it goes real. And there's nothing that changes from the video game to the real money. It's just practice, practice, practice. If you get good at playing video games, and you can move on to the next level, and you move on to the next level, and you move on to the next level, before long you win the game. Well, it's the same when you're trading. You just learn how to trade the game, but the game never ends. All right. You just keep moving up different levels. So if you want to do that, it's fun, and it's a good way to be able to learn how to make money, to get started investing. And that's the way I like to think about it. I like to think about, you have to have a job to bring in money, income. And either whether it's working at a gas station, which is what I did for many years, or if it's, becoming a doctor and fixing broken legs, whatever you do, dentist, drill teeth, you got to have a job, right? You go out and you make money, and then you bring it in and you invest it. And then you take that money and you put it into the stock market, which is what most of us do, all right, or real estate. Some of us do that. And we have real estate, or wherever you want to invest your money, but we're, focusing on the stock market here in this group of people. So we invest in the stock market. Chad saying he's going to invest it in Bitcoin. That's okay too. You can invest it in Bitcoin. So was it yesterday? No, I think it was the day before yesterday. Tuesday, I gave kind of a rant and a rave about stable coins, how they're not stable. So just be careful. I'm not a real fan of stable coins. Not yet. I don't know. Maybe, my view can be changed, but as of right now, the knowledge that I have of stable coins is something that I'm not interested in. But that was a rant for another day. If you want to see that rant, go watch that video that we did last Tuesday, and we talked a little bit about stable coins in there and why I'm not a real fan. All right. But for today, what we want to do is we want to move forward and look at our trade recommendations. So there's a number of ways you can trade the stock market, right? You can trade the stock market to day trade the stock market if you want to. Yesterday, we were day trading the futures market. We day trade the futures market because of the leverage. All right. You don't have to have that bare minimum $25,000 in your account to day trade. So you can start with $2,000 to $5,000 and get started day trading in the futures market. Futures market, of course, is exchanges out of Chicago versus the exchanges out of New York. And there's just a little bit different rules over there. There are no pattern day trading rules in Chicago. So we're limited. We can't trade all the stocks, which are all the wonderful things like Apple and Amazon, Netflix and Google, and all those things. You can't trade those in Chicago, not individually, but there are indexes like the S&P 500 and the Qs, the NASDAQ and the Dow and the Russell and things like that. We can trade those, plus all the commodities that they have over there too. You can trade those, but there's no pattern day trading rules. So you can start with a much smaller amount of money, and of course, because of the leverage, you can make just as much money or lose just as much money. So it works both ways, and that's the name of the game. So we make our money over there, and then we bring it over here and invest it. Now we can also trade over here. All right. trade over here in the stock market, and that's what we're looking at now. This is the stocks version, and I've got United Health up on the screen, and this is one of the markets that we put a trade on a couple weeks ago. And we took a break last week, so we didn't pay much attention to our portfolio for the class, our classroom portfolio last week, because we took the week off for the memorial. All right, but this week we're going to go down and review some of the trades that we made here. Now, we take this money that we make here in trading and then we invest it in other markets. All right, now I've been working really hard on getting something ready special for you at Pit News Magazine this month. So I've been writing an article, and it turned out to be a little bit more than I had anticipated, but it's great information. It's almost like a summary, a total summary of all the things we've been doing with the Yield Max and the Granite shares and the high dividend yield portfolios. All right, so a complete, almost one whole article that's just like complete from top to bottom, complete summary of everything we've been doing. And so we're going to take our money that we make from trading the stock market or trading the futures market, and then we're going to invest it. All right, there's a difference between trading and investing. Trading is buy low, sell high, buy low, sell high, buy low, sell high. Investing is kind of like, let's buy it and kind of hang on to it for a while and generate income off of it. And what we're doing is we're not just buying it to hold it for the long-term growth. We're buying it and holding it and regenerating income off of it. All right, with distributions, dividends, those types of things. So a little bit different focus, a little bit different way of looking at markets. And I oftentimes say that the stock market is like a sandbox, and you can kind of develop in the sandbox any type of financial model that you want. All right, you can structure your financial model that you build in the sandbox any way you want. You might want a great big sandbox or a great big castle or a little tiny castle, but either way, you can structure your deals the way you want. You can, we can almost mimic almost anything that goes on out in the real world, in the physical world, in the financial world, in the stock market. If we like the idea of buying and selling real estate, well, we could do that in the stock market just as easily as we can do it, actually easier than we can do it out in the real world. If you like the idea of rent, buying a rental property and living off the interest or off the rent, well, we can do that. We can do that in the in the stock market. We can mimic that. You like running a business? Well, we can mimic that too. We can set up a whole business structure within the stock market. It just depends on your brain and how you want to look at things. There's so many different ways of looking at the financial markets and doing the math. It's all about math. All right. We're all really good at math in high school, right? It's all about math, how you structure those models to take advantage of the markets and how you want to interact with the market. And you can structure almost any type of business model that you see out in the physical world in the financial world. Now, most people, their brains are stuck on the buy low, sell high, all right, or the buy and hold forever. And those are two models that, I'm not real fond of. The buy low, sell high is a good one, but the buy and just hang on to it until you die is not a good one. I'm not real fond of that. And a lot of people do that. That's what 401ks are, right? You work your whole life and you put money into your retirement account. And that's why at the end of 30 years, you have $130,000 in there because you bought and hold. And it's like, well, Len, that's what I've been taught to do. Yeah, it is. That's what you've been taught to do. Why do you think you've been taught to do it that way? Might be a reason why you've been taught to do it that way. All right. They want to keep you working. They want to keep you, they don't want you to get rich. They don't want you to be a millionaire. They want you to just put your money into a 401k. And when you retire, you have $130,000 and there you go. You're a happy camper, maybe 200,000, if you're lucky, you started earlier. But that's kind of the way it works. So you got to have some different strategies. And that's what we're here to learn in these financial classes, is to learn some different strategies that maybe make you a little bit more money than just a simple 401k. Not that a 401k is bad. It's not. I got one. I got two of them. I got an IRA, a Roth IRA, and I got a standard IRA. I got both, right? So 401k is basically the same thing. but there's ways that you can trade them to make more money than just, making a contribution every 2 weeks in your paycheck. Yes, Land, but the company gives me a 3% match every month. That's free money. Yeah, that's free money, 3%. Wow. Wow. Really good there. Okay, there's better ways, all I'm saying. And especially nowadays with some of these new funds that we've got available to us. And we're going to go over and look at them here in just a minute. We got to look at our portfolio. And then we're going to go over and look at our funds. I'm going to show you some of these new funds. That's what I've been working really hard in Pit News Magazine to write all this stuff up and give you a nice big summary of all these new features that are available in the stock market that we've never had before. All right. And that's what's so cool about them. But you got to understand them. They're different. They're not the same as the same old thing. And a lot of people don't like them. Why do they not like them? Because they lack knowledge. All right. They lack knowledge on how they're meant to be used. And if you use them improperly, well, of course, they're not going to work right. You got to use them right. Just like anything, it's a tool. So these are financial tools that have been given to you. And if you want to use them, great. If you don't want to use them, don't use them. But I like them. So I'm going to show them to you. I'm going to show you how I'm going to use them and help you guys make a little bit more than what you might make if you were just, playing in your 301k or a 301k. I don't think there is such a thing. A 401k in your retirement account. So the idea here is to make more money. And then we're going to take that money and put it into our long-term portfolio for growth. All right. So let's come over and look at this. The first thing I want to do is look at UNH, United Health Group. We talked about UNH as it had a great big flush, and in Pit News Magazine last month, Grant Thorne wrote a fantastic article about UNH. And if you haven't got Pit News Magazine, you might want to go get that and subscribe, and you'll get that article because that's the one that's current right now. So go get it, and it's the current version right now. You can get that article and read about the United Health and why this great big toilet flush came in here. They misrepresented how much money they were going to have to pay out in claims, right? And believe it or not, I know a lot of you guys in this class, we got a lot of pickleball players. You guys like to go out and whack those little yellow balls. I think it's a fun game. I loved it for a little while till I blew my knee out. And then that's what caused United Healthcare to fall. Land's broken knee. Yeah, basically. They actually, in their dossier that they put out as to why the market flushed so hard like this, they said we had more pickleball claims for knee replacements than we anticipated. Do you guys go play pickleball? How's your knees? Be real careful about your knees. That lot of, it's become popular with the retired crowd, a little bit older crowd. Pickleball is a really fun game. And not that the kids can't play it, they certainly do. And they're the ones that are in the tournaments and stuff. And they go out and it's really fun to watch those guys, the young guys, do it. But it's a fun game for older people. We like to do it. Go out there and get some exercise, play the pickleball game, and blow our knees out. And then we go and make a claim on our insurance, and United Healthcare had to pay all those, and that's what caused this. Now, it's not the only thing, of course, but that was one of the things they mentioned, that they had to pay for a whole bunch of knee replacements because of the rage of pickleball. Believe it or not, that was in their dossier. It said that's why we had this big flush, because of course UNH is an insurance company and they had to pay for the broken knees. So be careful if you're out there playing pickleball. Don't blow your knee out. I blew my knee out. I didn't have it replaced. It took me 8 months for it to repair, though, and I haven't been on the pickleball court only once or twice since, because I'm really scared that I'd blow it out again. Because I'm one of those guys, I'm just too competitive. I can't, that ball goes just a little bit, just this far outside my reach, I'm going to dive for it. I'm going to try and get it, or it goes, it's going to go out of bounds. Man, I'll run for it and I'll dive and smash into the back of the court. I just can't stop myself. I'm a very competitive player, and so I blew my knee out. Teaching people too. I was really excited about the game, so I was teaching all my friends and family, and we'd have little tournaments, and my son came out and we played, and I taught him, and I just really kind of got into it there for a while till I just destroyed my knee. And that's why UNH went down. But we don't think that United Healthcare is a bad investment. We think they're going to recover, right? And that's why we put this order in there, and they are recovering. And so my son called me the other day, and he's like, Dad, I put that order in when you made that suggestion. Man, I'm making money fast, hand over fist. He's really happy. He's making all kinds of money on this trade that we talked about right here in this class. So our option right now, all we did is buy a call option. We bought a leap 295 days out, right? Just a long-term leap. Because my idea on this was, hey, this thing's flushed way down. We got our nice little double bottom down here. And so I thought that maybe we would get a rally. And where do I think United Health is going to be next year? They fired the CEO, got a new CEO, brought in the old CEO that was making it work in the first place. And I said, well, where's this thing going to be in a year from now? So I put in a 295-day option, and this thing's up $8,000 right now. So that's a nice one. We only bought we bought 3 of them. So we bought 3 contracts, and it's still there. I mean, we could take some profits if we want to, but I still think there's some upside potential. You can see that we got our nice little, our little drive patterns here. This is a little double bottom formation, and then we got our first drive, and then we're in a little pullback, and we'll look for another drive in here. I think we'll get some rebounds on this thing. I think we got a lot more upside potential, so I'm not going to liquidate, not going to take it off. I'm going to just keep it for right now. If we wanted to, we could put in a covered call, but right now is not the time to be putting in a covered call. Well, the time to put the covered call in was right in here when it started to go red. We should have put a covered call in. Now it's starting to go green. The pattern for this is oftentimes it'll drop back down, get a couple more little reds, and then it'll hit that, cross that natural trend line or that little mathematical trend line right there, and then that's where it'll break. Usually we get a couple little bars in there, little green bars, then we get a couple red bars. We might be able to put a little short-term covered call in there. Let's go see how much they're worth. Should we just price them out for fun? We might do one. Let's see what we can do. Oh, 22 days. Let's look at 22 days. At the money's 1,200. If we go out, we might be able to do, these are called. Yeah, we got to sell a call. We might be able to do this. I think we're going to get a little bit more of a dip in here. That's just the way these patterns work. I can show you the pattern, right? We know patterns. Here, let's look them up. We got patterns. You might as well, we're in the class. We might as well go look at it. Here's our slides. So the patterns that we're looking at right now, the pattern that's showing up is this little recurring price pattern right here, right? And so what we do is we generally come down, the market comes down, rallies, gets a few green bars, which is what we're at right now. We're in that stage right there. We're getting a few green bars. Now this is the other way. So we're going up. So up, then we get a little pullback at the red bars, get the little green bars, and then we generally get another little set of red bars. And then it's once we get those little red bars, first green candle, make a new high, and bam, that thing takes off and goes to the moon. So we do have that little pullback to look forward to. It doesn't mean it's going to happen that way. It's just kind of a reoccurring pattern that happens often enough that it's worth putting money on. All right. So some of these little patterns, that's what they look like. And so this is that little pattern slide thing that we look at when we're trying to identify what markets are going to do. So back to here. And so you can see that's that little triangle formation in there that's coming in with the little area of support underneath like that. That's the little triangle. So we would expect one more little pullback, maybe get some red bars in there and then take off and go higher next time. All right. So it doesn't have to. It could have the little red bars. We see it all the time where it comes down, gives little red bars, takes off in another great big long green trend. But we're going to say, if we're going to do a covered call off of this thing, then we can come in here and say, well, I think maybe, and yeah, maybe we don't know. We just put it in there and we make our money. So we sell a couple of these. Now, how far out? Well, maybe we want to go up just above the previous high. It's 22 days. How far can this thing move in 22 days? There's $183 you could make if it's way out there. You don't want to cap your profits because you get everything in between. You get everything between here and here, right? You get all that profit, $4,700 from where it's trading up to that red line. And then you also get the premium. This received $228, but the market's got to go to that purple line to get that money. So, could it go up there and cross anything above the red line? If the market goes above the red line, well, we get the $227, but we don't get the $3,000 that would have gone if it went up there. So that's the game you're playing with covered calls. You want to put the covered call far enough out that it's worth it, make some money, but not so far out that if the market does blow past it, you don't cap your $3,400 loss just so you can collect a $227 profit. So you have to be careful, right? And That's why you want to kind of put them out there far enough that you don't have to worry about them. So if we get a little dip down in here, and then maybe this is where we think this market's going to come back up, do we think it can go all the way up there? It makes an extra $227 per, and we got 3 of them, so we could put 3 of them in here. So 1, 2, 3, we'd make an extra $682. That's probably worth the risk, right? I don't know, but I think so. We'll put it in there just for fun. We got to keep an eye on it. We don't want to have our nice little options taken away from us, which could happen. Right? That's kind of putting a limit order in there to sell them, but we're going to take the profits before that happens. So we're going to come in here and let's see if we can. I don't know if it'll let us market into these things. Let's do a limit. And so we're going to sell these things. So we're going to go to the 216, right? Oh, let's go in the wrong way. Maybe we do have to go up. We got to go to, that doesn't make sense. Let's just hit market order, see what happens. There we go. They gave it to us. All right. So they gave it to us. How about that? So we got our 3 options. We received $648. And that's the name of the game on that one. So we just picked up $648. Now the question is, how much of it are they going to take back? Right? That's the way it works when you sell an option. You sell an option, they give you the premium, and then if things don't go in your direction, you have to start giving the money back. All right? You have to give it back. Whereas when you buy an option, you have to pay, and then when it goes in your favor, they start giving it to you. Okay? Giving it back to you. That's how it works. So they give it back to you instead of give it to, that's both sides of the trade, right? You got a buyer and a seller. If you buy, you have to pay, and that goes to the guy that sold it. And then if the market goes in your favor, for the sold guy, well, you got to keep your money. But if it goes against you, they start taking it away. You got to give it back. And that's the same. Who are you giving it to? You're giving it to the guy that bought it. So if you have to give it back, you have to give it to the guy that bought it, and he's making money because he sold it. Now you got to give it back to him. All right. So that's how it works. Just buy and sell back and forth between 2 guys. And that's what these 2 are. We sold it. We bought it here, and we're going to sell it there. And whatever the market does will determine who gets the money. Now we're on both sides. So we get the money both sides. That's the name of the game. All right. So I take it out of the left pocket and put it in the right pocket. Okay, so let's go look at the next one. That's United Health. Let's go to, you know what? Who was it that said, let's go put some money in BlackBerry? Was it Kurt? Kurt, was it you that was, or who was it? Can't remember. Might have been, I think it was Kurt, was it you who said we should go look at BlackBerry? Anyway, we put money in BlackBerry. We put a little strategy in here. We bought long call. We bought 500 shares, and we also sold some premium to collect some premium. So it paid out. Let's go look at our positions just on this chart, and you can see that the 500 shares are up $395. So that's what we did. We bought 500 shares of BlackBerry, and on those 500 shares, we're making, it looks like about $400. And so that's the difference between options and buying shares. Buying shares, nothing wrong with that. But look at the difference in value. These options, we bought a call and we sold a put. So we put on what we call a synthetic long position. So it's the exact same thing as if we had bought 100 shares, but instead we did it with leverage through the options market. And that's why this is doing this. We bought, we bought 79 of them and we sold 79 of them. That's because it's only a $5 stock. So that worked out pretty well for us. We spent some money on this one. I think we spent like $5. It looks like cost basis was $5, $6, $7, $8, $5, and then -$3. It was $2,000. That was a $2,000 investment for the options version, and then it was a $2,000. Cost base $1,800. So we tried, it looks like to me, I'm trying to remember what we did just by looking at it, but it looks like to me we put on 2 versions of the long position, one with options and one with shares, and we paid about the same amount of money. So we paid about $2,000 for the synthetic long options, and we paid, for 500 shares, we paid about $1,800, almost $2,000. So we're doing the same thing. So we got $9,000 for the long call. It was making $9,000, and we've we sold the puts to pay for it. So that's how we collected the premium, which got us down to $2,000. And that's now lost 1,100. So against our cost basis of 3,000. So we're still up on both of them. That's why we're up $2,000 on our sold puts. We got 113 days left, and we got $4,400 on our long call. There you go, man. That's like classic, right? Straight out of the manual. That's a good trade. Very, very good example of putting on a long synthetic long position versus a just buying the shares and seeing the comparison between the two. So we're up 4 or 5. Let's just say call it 2. So it's 4 or 5, 6, $6,000 what? $400, $6,300, $6,300 on the long position that we put on with the calls, and it costs us the same amount of money as buying 500 shares, which is only up $400. So that's why we do options. That's why it's worth learning options. So if you're like, options are too hard for me, I don't want to do that. Well, okay, then you're saying I'm happy with the $400 rather than doing the exact same thing with the exact same amount of money to make, $6,000, $7,000 versus $500. That's why we do options. You got to learn options. All right, if you're going to trade. Now, if you're not going to trade, you don't have to learn options. But if you're going to trade, you got to learn options. Now, that brings me to that crossover into what we're doing over in our long-term portfolio, right? Because we love options, and that's how these big funds that we trade, right? The yield max funds, that's how they trade. They trade options. This is what they're doing. This is their strategy. And so they do that, and we don't have to trade it. We just give them our money, and they do this for us. And that's how they can make those big returns. That's how they're able to generate those big returns. You're like, well, how can they make those big returns? That doesn't seem right. How do they make that kind of money? Well, this is how they do it. They do it with options. So they are trading the market. They're trading them with options. And then because you gave them the money to trade with, they give you back your profits, all right, or losses. Doesn't mean that just because they're trading your money for you that they can't lose money. They certainly can. So trading is trading, whether they're doing it for you or whether you're doing it yourself, right? You can lose. Anybody not know that? Anybody not know that you can lose money doing this? Of course you can lose money doing this. And the big boys, they lose money too. It's not like, they're immune from losses. And if you give them your money to trade and they lose money, well, you lose money. But if the market's going up, generally speaking, the strategies make money. But when the market goes down, the strategies lose money more slowly. All right. They still lose money. They just lose money more slowly. The strategies that they use in those yield max funds that we like to trade. All right. So this is the strategy that they do. And this is a great example to show you exactly what yield max does. They do the top two and they don't do the bottom one. Okay. The bottom one is just buy and sell. That's what you do when you just buy. That's why your 401k at the end of your retirement is $200,000 as opposed to $2 million. All right. It's because of the leverage that you've got in your 401k, which is zero. All right. So that's BlackBerry. Kirk saying it wasn't me. Somebody came, I can't remember who it was in class, and they said, go put some money on BlackBerry, or let's go look at BlackBerry. So we put this on as an example. I said, I'll show you what the yield max funds do, and we'll put on some shares to compare. And that's a great comparison. I'm glad that turned out nice for us. All right. Here's Ford. Ford, we put on a simple premium collection strategy, and Ford's flushing right now. I think we ought to just take our profits off on this one because it's just got 57 days left and the market would have to rally, and we've got half our profit. We got 50% return on this thing now. 65% return. So, and it's capped. We can't make any more than 100%, and we're up 65%. The market looks like it doesn't want to rally anymore. I think we're just going to liquidate this, take our profits, take our $255 out. So liquidate our multi-leg. See if we can mark it out of it. And no, it's not going to let us. All right, let's go over to our orders. Let's come in here, liquidate the multi-leg, and we're going to have to go to, let's see, 60. See if it'll let us do it that way. There we go. All right, we got it off. Let's see what we got. Our closed position, Ford, $230. All right. So that turned out nice. That was a nice trade, 65% return on our money. And how long did we have it? 2 weeks? Hold on a second. Losing my voice, and I didn't prepare very well. I didn't bring my lemon water, so I'm here without any lemon water to drink. Okay, so let's go over and look at our next one. What are we going to do with Ford? Are we going to do anything with Ford? We could short it. We could short it. We got a little V double top, and it looks like it's flushing back down. How far down is it going to go? We don't know. Nobody knows, but we could make some money off of that. How would you make money off of that, Lan? Well, you could sell some premium up there. We could come in. You could buy a put if you want to, but the market would have to flush pretty hard and pretty fast to make money on a put. All right, falling put. So it's better, in my opinion, to sell some premium above. So we come in here, we could go out 57 days or something. Let's see if we can make any money on this thing. What do we got? Oh, let's come on here. Come on, chart preferences. Let's tune this down a little bit. Yeah, that's better. All right, so we're going to come over here. 13. Oh, there's no money in these things. We'd have to be pretty close. We come down here. That's all right. We think the market's going to fall anyway, right? So we can put it there. That's only $39 in 22 days. That's at 57 days. You're going to get $39 in 57 days. And you're going to have to buy insurance. Go buy insurance. Put the insurance policy up here. Where's that going to go? One out. 15. You ain't got to make any money. 11%. I guess 11% return on your money is not bad in 57 days. Can't get that down at Cash Valley Bank. Cash Valley Bank ain't going to give you 57, ain't going to give you a 12% return in 57 days. How many 57 days are there in a year? Let's go calculate that out and see what that is on an annualized return. So that would be 365 divided by 57. So that's there's 6.4. So let's just say 6, just to be on the conservative side. So 11% return, 11.97 times 6. That's about a 71% annualized return. That's not anything to sneeze at, right? I mean, you can't go down to Cash Valley Bank and say, hey, I'm going to give you my money. I want a 71% return this year. Give me a CD with a 71% return. What do you think they're going to tell you to do? They're going to tell you to go pound red sand. Why red sand? Because we're in Dixie, man. We're down here in the south of Utah, where all the sand is red. And Cash Valley Bank has a branch down there. So if you go in there, they're going to tell you to pound red sand. I ain't giving you no 71% return on your money. And here we are looking at this going, that's not enough money. I'm complaining about this. Why would I ever do that? That's too much money. That's not enough money. Why would I even take that risk? Well, the reason is because that market, if it turned around and went back up there, you'd lose the entire investment, which is how much? How much are we putting into this thing? $459. So you're going to receive $55 and you're going to risk $459. But your probability of being in the money is about 40%. Looks like 40%, 21% probability of being in the money. You got about a 40% chance. That's better than you get. That's better odds than you're going to get in Vegas. Not that we're comparing it to gambling, which we're not doing, right? Somebody told us we're not gambling. I believe them too. All right, so that's that game. Let's go ahead and put that on. So we're going to come in here and we're going to do 10 of them. So that'd give us $550, and if we lost, we'd lose $4,600. All right. But that market would have to hit the purple line above the red line. You think the market's going to hit the purple line above the red line? Could just turn right around and go back up. And if it does, we're going to have to liquidate out early. And we're not going to wait for it to go and lose our entire $4,000, of course. If it starts to lose a little bit, if it goes up and looks like it's going to turn and rally and start making higher highs, we're going to get out of this baby. We're not going to hang on to it. So we'll take a hit, but it won't be the full 4,000. That would be the max profit if it stays down here. We just need it to go hit that purple line underneath the red line. That's the carnival game we're playing. All right. Hit the purple line anywhere down here. We don't care. Anywhere you want on there, Ford Motor Company. Hit that purple line underneath the red line and we'll get $550. If it goes up there, well, we're going to lose. If it hits the purple line above that red line and we don't get out prior to that, like over here, well, then we're going to lose $4,616. All right. Does Land want to really do that? See if we can mark it into this. Ah, they said, no, you can't mark it into that, and they took it away. All right. I'm not going to set it back up. We'll do that. You guys go. If you want to do that one, you can do it after. I'll probably go put it back on later. I don't want to waste your time putting that back on and trying to find the limit order that's going to let us do it here in the demo account, because this is the demo account. This isn't real money. Real money, I don't think, if you market it in, I don't think it's going to do anything. But if it didn't want to fill, it would just hang there. It wouldn't sit there and throw it away like the demo account does. Demo account likes you to use limit orders. All right. So here we are. Let's go back to the last one is Viverva. Ivovonance. Ivovance. Ivovance biotherapeutics. Right? Hard word to say, especially for us boys out here in the wild, wild west. Okay, so this is Iovance biotherapeutics. Biotherapeutics. All right. So why did we put this order on? We put this order on because this is one of the markets that we were day trading. Remember, we came in and we went to the little bubbles and we were playing bubbles, and bubbles came up and it said this market had a big rally, and we saw this little first rally and we saw the little second rally, and we thought, well, maybe this thing has the little oomph to go. And of course, on a day trade, it had the little news event right here, which caused it to rally. So we were like, well, look, I mean, it's a $3 stock. This is why when we play these little penny stocks and you day trade them and you go down and you day trade your penny stocks and you even make, your couple $1,000 or a couple $300 on your penny stock. And then you're like, well, this has been such a great penny stock. I'll just hang on to these things. Most of them don't work out. I'd say 90% of them don't work out. They don't take off and go to the moon. Some do, which is why, you might want to put an option on there just to see. But most of them don't. That's my experience. You go in there and play these penny stocks off of bubbles. And remember bubbles? Let's go look at bubbles today. And bubbles is where we do our day trading on the stock market. Now we're not doing that today. We're going to go look at our portfolio rebalance, and I'm going to show you some mistakes I made. But if you go over and you look at bubbles, where is bubbles? Oh, there she is. All right, here's bubbles. So here's what the market's doing today. Lots and lots of red. That's pretty ugly today. So we're going to come over and we're going to go into the bubbles version of the heat map. And this is bubbles. And oh, look at KMX is screwing the whole thing up. So let's take that out of there. KMX. All right, so there's bubbles. Nothing's really percolating up today. Everything's down. So what are the big ones? Apple, of course. Apple, Nvidia, Microsoft. Where's Tesla? Tesla's usually got a pretty good. Amazon, Google, some of these big circles over here. What's that right on top of? That's Google, Meta, Tesla. There's Tesla. Look at little Tesla down there. What's he doing? He's flushing. He's had a big run. Elon went and bought $1 billion worth of his own stock and caused that market to take off like a rocket ship. But we were also long Tesla. We had a lot of money in Tesla, so that was good for us. We made a lot of money in Tesla. And that was good. Look at Palantir, little Palantir up here. It's getting ready to flush back down too after that big rally. So the question is it going to just pull back and rally again, or is it going to continue to rally? I don't know. Nobody knows. Nobody knows what all this stuff's going to do. You just got to play it the way you see it. All right. JP Morgan, IBM. Wow. Look at IBM taking off like a rocket ship. Intel, of course, Intel's going up. I don't know what to think about that Intel. A little disappointed. I've always liked Intel. I've tried to buy Intel and invest in Intel and have Intel and hold it, but it never would make money. It just kept going down, down, down. Now, the federal government came in to rescue it. And what did they do? They went and bought shares in it. I don't like that. I don't like that. Trump administration went in and actually bought 10% ownership of Intel to save it, to rescue it. And they bought it with you and my money, right? So the federal government is now part owner of Intel. You're like, whoa, that's good. Intel does well. American people get paid. Yeah, but why are we doing that? That's picking winners and losers. That's what we complain about China. That's what China does. China has state-owned companies, right? They go in and they pick the winners and the losers, and they invest in these companies. And the government controls the companies. That's why we're so pissed off at TikTok, right? Because China owns it. ByteDance is the company, but China basically bought shares in ByteDance and owns TikTok. And we're like, well, you can't come into the American country. We want you out of here because China owns TikTok. Well, here now, Intel, we turn around, did the same damn thing. Doing the same thing China's doing. We're picking winners. We're buying into Intel. Not that I don't think Intel, nobody wants Intel to go out of business. Intel makes the chips for your laptops and your PCs and all this kind of stuff. It doesn't make chips for AI. And so all the AI been pushing Intel out the door, right? They can't compete for all those big AI chips. They're the CPUs but now you've got AMD and you got a couple other companies making chips for CPUs too. So why did we pick Intel over AMD? Why didn't the federal government go in and say, well, we're putting 10% into Intel. Why don't we go put 10% into AMD? So now AMD is working at a disadvantage. That's not fair. It's not fair. It's not fair for the federal government to go in and give Intel money. They didn't give AMD money. It's not fair. That's what they do in China. That's what they do in North Korea. That's what they do in Russia. Communist countries. That's what they do down in Cuba, right? The governments take ownership. They pick winners and losers. Why is the U.S. doing that? I don't want Intel to go out of business any more than you do. Wouldn't be good for the country. Wouldn't be good for the economy. But it actually might be. It might be good for Intel to suffer a little, to go out, to have to reorganize, to have to cut some fat, right? Why are they losing money? Well, because they're not running an efficient machine. So the government runs in there and says, oh, well, we don't want Intel to go out of business, so we're going to give them a bunch of money so they can continue to be a bad company. It just rewards them for not being a good company, for not managing their position, managing their people. They're hiring too many people. They're not firing them. They're not laying them off. They're not innovating. They're not doing all the things they need to do to grow, to be competitive in the competitive world. And the federal government goes in and saves their sorry asses when they don't deserve it. They should just fix their problems, not just have us come in and give them money so they can continue to operate under rotten position. That's not fair. AMD has to operate now even more efficiently because they have to compete not only against Intel, who can run their company inefficiently, but they're getting all pumped up with the American dollars, getting steroids pumped into them. That's not fair. I don't like that at all. And now they're talking about doing it with other companies like some of the big defense contractors like Lockheed Martin. I don't like it. I don't like it at all. That's not capitalism. That's socialism. Don't do it. Why are we doing that? Bernie Sanders is all on board. He thinks it's a great thing. Oh, yeah, that's a great thing. Let's go do more of that. Never really agreed with Bernie Sanders. So why are we doing something that Bernie Sanders thinks is great? This doesn't make sense to me. I think there's, I don't know, could be better ways to do it. Hire a management team for them or something. I don't know. Encourage them to get a management team to go in there and reorganize. Let them go bankrupt and reorganize. I don't know. You don't want them to go bankrupt because then all the people who they owe money to loses the money, and then that just destroys the whole country. They just need to reorganize. It's not like they're a little company; they're a monster organization. We don't want them to go out of business, but I don't think they would. I think they would force themselves to reorganize and fix their problems, but now they don't have to. Oh, we don't have to fix our problems. The government's giving us money. Let's just keep operating poorly like we've always done because now we just got a bailout. Oh, yay, yay. That's not good. Anyway, that's my rant and rave about that. That was an article in Pit News Magazine. Now we got another article coming out in this Pit News Magazine. That was Grant Thorne wrote that one. And now he's writing another one that's just going to blow your socks off. Can't wait to blow your socks off with this other Grant Thorne article where we're going to be talking about fusion and how we're going to pay for all of this electricity. Did you hear Elon Musk the other day said that he was going to have Elon Musk was going to what was he going to do? He said he was that they were going to be doing 1 gigabyte. I don't know how much it's electricity. One thing of electricity, 10 things of electricity. I don't know. Is it kilowatts? 1 kilowatt of electricity, 10 kilowatts of electricity, 100 kilowatts of electricity, and you're like, okay, great, 100 kilowatts. You know how much a kilowatt? I think it's a kilowatt. Somebody's going to correct me in the chat if I'm wrong. Do you know how much 1 kilowatt of electricity is? It might be a kilobit, kilowatt, I don't know. I'm a computer guy. I'm not an electricity guy. But, kilobit, kilogigabit. I don't know. Anyway, 1 is what 1 gigabit, however it's whatever it is what 1 nuclear energy plant creates. 1. And they're talking about needing 100. Elon says that he's going to be the first to have Grok, his AI system, have 100 kilobits, gigabits, whatever it is, 100 of them. 100. That's 100 nuclear power plants. Put the power from 100 nuclear power plants. He's going to be the first one to reach 100. He says 100 nuclear power plants to run his AI system. So they're not going to be able to do it with wind power and solar. They're going to have to do it with something else. And everybody's talking nuclear, but I don't think it's going to be nuclear. I think it's going to be fusion. And I am of the opinion, I believe, my sources tell me that fusion has already been invented. Now, we got all these companies out there working on fusion, but they're not the companies that we want to work on fusion. You go work on fusion doing it that way, because we've already invented fusion over here doing it this way. And we don't want you to know that you can do it this way, because they really don't want fusion. I know it sounds like a big conspiracy theory, but I believe it is. Because you got the whole world runs on oil. And as soon as fusion comes out and you're able to do all of this stuff with fusion, the oil, if you come out and suddenly tomorrow and said, we've got fusion and we can, free energy, you don't need oil anymore, oil and gas, what would happen to the economy? Whoa! Everything runs on oil and gas right now. And the whole world runs on oil and gas. And if you take that away, it's going to destroy the economy. Yes. Now, if they did come out with it immediately tomorrow and say there would be a slow transition off of oil, because it's not going to happen overnight. But nonetheless, this entire world going from gas to fusion, and they're scared to do it. And of course, everybody who's got interest in oil doesn't want that to happen. And you've heard the stories before. It's like, oh, I came out with a car that runs on water, and next thing you know, the guy's dead. Who killed him? You've heard those stories before. But it's kind of that. But you know what? I am of the opinion, my sources tell me, fusion has already been, we're already using it in the military. It's already there. So Fusion energy is already there. It's already been solved. The problem is fusion. Now we're in an arms race with China, right, for AI, artificial intelligence. And the first one that gets artificial intelligence, gets super artificial intelligence, kind of wins the race, right? So the United States wants to be that country. We want to win that race. And so now what are they going to do? They're going to have to crack open fusion to get all the electricity. Because if you look at the electrical growth of China, it's way up here, and the United States is still way down here. We haven't been making any new electricity. But China's been making new power plants like every day. They put a new power plant online. So they got electricity out the wazoo. They don't have an electrical problem. They're going to beat us if electricity is the problem for AI. And definitely AI, electricity is the problem. So what have they decided to do? They're going to crack open and they're going to bring fusion online to power all of these AI systems. Because I believe the Department of War, Lockheed Martin, which the federal government wants to buy, like they did Intel, they want to buy Lockheed Martin. And Lockheed Martin is one of the companies who has invented in the military industrial complex, who has invented or has discovered fusion. All right. We've got fusion. We got fusion. We have not bombs. I don't want to call them bombs, but weapons. We have fusion weapons. Did you know that? We have fusion weapons. Not well known. It's been discovered. Not because they wanted us to discover it, but we saw them using it. We caught them using them. Not me and my brother. But there's guys on the internet who there's videos of fusion weapons being used, and they caught them on video. And they're doing all the reverse engineering to try and figure out how they did this stuff. And that's where it's coming from. And that's where all this, and Microsoft has already laid down money. The articles in Pit News Magazine, I'm kind of giving you a heads up on this article in Pit News Magazine, all about fusion that's coming out. You got to read the article. It's like, it's going to blow you away. Okay. So we got fusion, and that's Lockheed Martin working with some other fusion companies. And it's going to happen here real soon because we got to bring it online. You can't just use it as a weapon now. You got to turn it into electrical plants and electricity so that we can have the AI race and win the AI race against China, because we're way behind in the AI race as far as electricity goes. All right. And it takes lots of electricity, lots of kilowatts. 1 kilowatt. I think that's what it is, right? A kilowatt. 1 kilowatt is how much one big city takes. You can, one nuclear plant puts out 1 kilowatt. And Elon Musk says he's going to be the first to have 100 kilowatts. That's his goal. He wants to beat the other companies that are working on having 100 kilowatts. And you've heard Trump say they're going to let these AI companies become utilities themselves, build their little nuclear plants right there on site. All right. Microsoft's already got a deal with a fusion company to provide electricity through fusion. Already paid them money. Already got the deal inked and signed. Fusion electricity for Microsoft. Already inked. The deal's already done. How about that? So how are we going to make money off of it? Well, you got to read the article in Pit News Magazine where it lines out all the companies that you got to buy and make money. Of course, Lockheed Martin's one of them, right? Let's go look at Lockheed Martin while we're talking about it. I know I'm drifting. I'm supposed to be showing you the mistakes I made in my portfolio, but this is more fun. Lockheed Martin, LMT. Is it Lockheed Martin's LMT? Yeah, LMT. Look at this. Look at this. Look at this. I think Trump announced that they were going to buy Lockheed Martin, and look at it go up. Straight up. It's like it's on Viagra. Barely even got a couple little red opportunities in there. Holy cow. Len, when are we going to be able to buy into Lockheed Martin? Well, I think we got to get a little pullback in here. We got to get some of these guys that just bought all this to take some profits. And if they'll take some profits and drop this thing back down, if we can get it back down into this red zone, which would be the Fibonacci sweet spot, right? If we want, come on, guys, take your profits. get the traders to, you know, you got a lot of investors who like to buy and hold and never sell. But you got a lot of guys that trade it too. So they want to take their profit. So buy low, sell high. So we got to get ready to sell. And when they sell, it's going to push this market back down. And when they push it down far enough, we'll have to wait and see if we can get it back down into this region here. And then we want to be buyers and go for the big run on Lockheed Martin, because the government's going to buy them. They're going to buy just like they did Intel. They said they were. I don't know. Let's see. Nobody's giving them any pushback but me. Land Turner's the only one saying anything about it. Come on, Trump. We all like Trump, but I don't like what he's doing. I don't like him buying these companies. But they want to buy Lockheed Martin because it's got fusion. They've invented fusion. They got the fusion power. And they want to own it, and they want to tell them what to do. Why do you think they want to own them? Oh, because we're benevolent. No, bullshit. That's not why they want to own them. They want to own them so they can tell them what to do. Hey, I'm 10% owner. You don't have voting rights. I don't care. I want you to turn your weapon, which is a fusion weapon, I want you to turn it into an electricity plant so that we can win the AI race. Okay, you own 10% of us, I guess we'll do it. You want the government telling private industry? Not like Lockheed Martin is private industry. They're already just part of the military industrial complex. They're the government without all the government regulations. That's all they are. They're just government contractors. They're just the government without all the regulations. That's all they are. So they can break all the law, break all the rules. That's all they are. But look at this. They're coming up here, touching this previous high along that trend line, right across the top of where all those other markets were before. Let's see if we can get a little pullback on this thing. Just enough to. That's one of them. And there's like 3 or 4 more. Of course, Microsoft's one too. Why? Because they're the ones who are buying. They're the ones that are paying for it. MSFT. They're paying for the fusion plant. I'm not going to tell you the name of the company, the fusion company. Some of you might know. I'm not going to tell you. You got to go read Pitt News Magazine to find out who the name of the fusion company is. Now, they're not publicly traded, but they probably will be soon. But the company that's going to actually build the fusion for them, for Microsoft, you could probably just Google it, or look it up. Grok will tell you. But just go get the article from Pitt News Magazine. So this is Microsoft. Microsoft's made this massive run. This is what is this? This is an X1SA1. X1SA1. Look at that. There's our nice big massive drive. We're getting a little ABC top formation coming in here. It'd be really nice to see Microsoft pull back into the Fibonacci sweet spot, which is, you know what, you guys, I've been telling you, we got to prepare for a big downturn in the markets. It's not happening on we got to get a little bit of a flush back. There's got to be some of these big firms they want profits. It's the accumulation distribution model. And I'm telling you, it's coming. And when it comes, it's going to hurt. It's going to hurt. It's going to be painful for some people. Look at where we're at. We're right here, right now. We're in this zone here. You know, you tell me. That's the accumulation distribution model that the big, huge firms do when they want to buy low, sell high. That's how they make money. That's how BlackRock makes money. That's how, all the big hedge funds make money. So we got some downside coming. Now, is it going to go this far down? I don't generally anticipate that. I generally anticipate this one here, which is a little bit more, not quite as aggressive to the downside. But this is the one I expect. So we're going to get drive 1, drive 2, drive 3 to the upside. We didn't get 3 drives. We just got one massive drive. Now we're getting the little pullbacks here. I think this is where it's going to come in. We're going to get these little drives back down into the Fibonacci sweet spot before we turn and start to go back up again. But that's our accumulation distribution model right there. And that's your Elliott Wave 3-drive pattern. It's kind of hard to see in there, but this is drive 1, drive 2, drive 3. These are your little hesitations, right? And then you get the top out here. You get the spring that gets everybody thinking it's going to go up one more drive, and then it flushes, comes down, goes down, and goes sideways. And that's where we get the spring, and we start headed back up. That's the 50% retracement level. So markets generally go sideways in here for a little while, then they take off. Now, is it going to go down that far? I don't know. Nobody knows if it's going to follow that directly. But if it does, we anticipate this thing coming down into this region here. And if it does, that's going to be painful for a lot of people. And everybody's going to complain and blame it on Trump, but it has nothing to do with Trump. All right. They're going to use it against him. But the market's going to come down and they're going to blame it all on tariffs. And that's going to all happen right around the time that Amy Coney Barrett gets to decide whether the world collapses or not. It's all on her shoulders, the snake. All right. The DEI hire. Trump had I got to have a woman. And he got a snake. He got to put a woman in there that's liberal in disguise. She put on it was a liberal that put on a MAGA hat. And so, oh, look, there's a woman with a MAGA hat. Let's put her in there. And then when she got in there, she took her MAGA hat off. she's a horrible woman. She's the snake that Trump always talks about in his speeches. She's going to turn on us. And it's all on her shoulders on whether we're going to keep the tariffs or not. Tariffs are good for this country. Anybody tell you otherwise, they got an agenda of their own. And they want Trump to fail. All right. Tariffs are good. That's what's making him succeed in everything he's doing. And she's going to take those. If she takes those away, and the rumor is she's going to take them away. But it's a scary thing if she takes those away. So that's what's going to happen. This is my bet. We're going to see this market come down here. We're going to see all this flush down. Amy Coney Barrett's going to have all the pressure on her. They're going to be saying, you know what? See, tariffs are causing this market to flush. Take the tariffs off. Because they don't want Trump to succeed. They don't want the tariffs. They don't want the U.S. to succeed. They want to have globalism. They want to have world dominance through world economics. They don't want to have nationalism, pride. They don't want to have countries like America doing better than everybody else. So they're going to push. Watch. They're going to just, whether it happens because they make it. They're not going to. It's not really. They have all the money in the world, so they can control and make things happen. But the thing is, they're going to use it as I bet you anything. I'm just seeing the world future here. I don't know. I'm just guessing, just speculating here with you guys. I think they're going to start. The rhetoric is going to get heavy if these big tech companies and all the stock market starts to blow off. Right when Amy Coney Barrett has to make her decision on whether the tariffs are good, and they're going to blame this all on Trump and the tariffs for the stock market going down. When all it is profit taking. It's just profit taking. It's just how the algorithms are designed. When you make that much money, buy low, sell high, they got to sell out so that they can make their money. So the market will come back down. They can start buy back in again, and then they can do it over again. Buy low, sell high, buy low, sell high. It's just a process of profit taking. That's what causes this. So these are profit taking down in here, and the algorithms do it over a period of time. They don't just do it like you and me, where we buy all in one day. They got trillions of dollars in there, so they have to do it slowly. They slowly move in and they slowly move out, and in the process of slowly moving out, it causes the market to make these little pullback waves and back down into the Fibonacci sweet spot area. And they're going to do it right during Coney Barrett's decision and the markets are going to be coming down. Let's go look at the SPY. There's another flush right there. I know we try to look at a 3-drive pattern and sometimes we try to make things happen that aren't there, but drive 1, drive 2, drive 3. Even if it's not what I'm saying, we're getting really heavy up there. I mean, we're getting so scary. This is scary country. All right. Getting scary country. Not that the market's going to flush and have a big recession and all that stuff. It's just profit taking. Are we going to get something that big over here? It says yes, because the farther it goes up, the bigger they are, the harder they fall, right? The bigger they are, the harder they fall. So the fall, to get it back down even to 38.2, even if it comes down and touches its previous high, does a Fibonacci bow tie, right? Fibonacci bow tie. Done, 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 done. Tie off at the bow tie. That's still a massive drop. Still a big fall in the market. And they're going to use that against Trump to get their way and get those tariffs taken off. They're going to put all that pressure on Amy Coney Barrett because her decision is coming here mid-October. Scary stuff. You see the politics play. See how they're working this out in their brains. All right, let's go over and look at our portfolio real quick. I know we're out of time, but we're going to come and look at it anyway. All right, let's go over to my portfolio. Where is it? There it is. Okay, so this is what we're doing. Now this right here, and I showed you this before for those of you who have been in my class. I'm working on my numbers here. And I'm trying to roll my portfolio from some of the older funds that I'm not as enamored with, I guess you could say, into the newer funds that I've discovered since we got these new tools that lets us discover, for example, TSL. We'll just use it as an example, TSLY. You can come in here and you can see the gain and the yield and the total gain plus yield. So this is what's given me my, and I've showed you this before too, this is what's given me my little, I've gone through and done all the math on all of these, and that's what I've created here is this table. And so now I'm moving out of some of my older funds that are not producing as well into some of the newer funds that are producing better. And that's called, you know, rebalancing my portfolio. So I'm rebalancing. But the problem is I didn't rebalance all at once. I was like, I'm going to rebalance my portfolio. Go in there and sell everything off, buy everything. It was not a wise decision. Don't do that. I've learned not to do that. Don't do that. Learn from my mistakes. And it's not like it's a, you know, I have $1 million in here. And I know to some that's a lot of money, but it's really not in the investment world. I mean, $1 million is a small account. So to be able to do it all at once in a small account is easier than if you have a big account. But mine's not a tiny account. It's not 100,000. It's not 50,000. It's not, you know, 10,000. It's $1 million. So it's still big enough that I need to be more strategic about my moving my money around. Now, if I only had $5,000 in there, it's not that big a deal to rebalance. You say, oh, well, you know what? I'm in a fund that I don't like, and I want to put it into a fund that I do like. Okay, well, you got $5,000. Sell your $5,000 and buy another one $5,000. It's like, but Len, you can do the same thing with $1 million. Just go in there and sell $1 million and buy $1 million. Well, it's not in one fund. It's in 10, 12. And I have to rotate them through. And which ones do I want them in? And which ones are better? And so we've never had that luxury before of having a tool that would help us make that decision. Now we do. And so I started making that rebalance before I had all the tools available to me in Portfolio Matrix. Now we got Portfolio Matrix, I can do it a little bit more wisely. So I can use Portfolio Matrix to help me rebalance my portfolio with this little targeter. So I can come in here and I can say, okay, these are my open positions. And I've showed you guys this before, but this is kind of how I'm working. So this is my new, what I got to do is I got to get my new list, right, of what I want to have my things in versus what I have my things in. So this is what I have them in, and I have to get them into these other funds that I would rather have. And I got to get them out of the old funds and into the new funds. And I need to do it slowly because I need to also tax loss harvest, because if I take some of the losses on the NAV more than I need, I want to take just enough that I don't have to pay any taxes, right? I want to work that out so that I can, when I sell off, because this is how these big funds work. Let me show you. Let me come back here and give you a back up just a little bit. TSL, let's go to TSLY. We always like to use Tesla, all right? TSLY. And you can see that when you buy the stock, all right, these funds generally, in this case, we had this big sell-off, right? And then this is the recovery. And you're like looking at that and you're saying, that's not a recovery. It just went flat sideways. But it was the recovery, because if you come over and look at, and remember, this is TSLY, not TSLA. TSLA, if we go to TSLA and look at TSLA, that was the recovery. Remember, we had this big drop. And remember what I said earlier? Even with these funds, if the market falls, we all lose money. I mean, it's not like the markets make money irregardless of whether the market goes up or down. These funds still lose money. They just lose money more slowly. They don't lose as much as you would if you were in the underlying stock itself. So for whoever had the money here, bought it here and sold it here, that lost a lot of money, right? That's a huge loss. Now, if you bought it here and you just hung on to it and rode through that whole thing, you made all this money and then you lost it all. So you lost all of your open gains, right? Now we're turning around, coming back up. That's the problem with buy and hold, because you never make any money, because it goes here and it goes up and it comes down. And yeah, maybe over 10, 15, 20 years, it'll go higher. But through the process, you made a whole bunch of money and then you just lost it all. And you had to start all over again from zero. Now you're making a whole bunch of money. What's it going to do? Probably flush, because what is it going to do? What do we do? What do we have? We have the Wyckoff accumulation distribution model, which is how the big boys trade, which is why the market goes up and down, up and down, up and down, up and down, because that's how they do. They buy here, they sell here, they buy here, they sell here. And over time, yeah, it's going to buy, sell, buy, sell, buy, sell, and it's going to stair step up. But in the meantime, you missed all these opportunities going up and down. Well, it's hard, Lan. I don't want to do that. I'm not good at it. Okay, well, then don't do it. Just buy and hold. But you're not going to make as much money. Just realize don't blame the messenger, right? Don't cuss me out. Don't say, yeah, that's a good strategy. I heard it's a good strategy. It is a good strategy for people who don't know how to trade, right? That's why you end up with your 401k at the end of 30 years of investing with $200,000 in it, because it went from here to here and you made $200,000. But in the meantime, it went like this. And the guy that bought low, sold high, bought low, sold high, bought low, he's got $10 million. But it's hard. I don't want to do it. It's hard. I don't want to learn it. I just want to put it all in there and be rich, rich, rich beyond my wildest dreams at the end of my life. Well, that's not going to happen. All right. Okay. You got to work it. You got to work the system. You got to work the system. So that's the whole reason we're here, because it's hard. So we now have funds available to us. We have these yield max funds where they're going to trade for you. You give them your money and they're going to trade these option strategies I showed you earlier, right? That I showed you over on on what was that little blueberry, greenberry, yellowberry, whatever berry color it was that we invested in, and I showed you the strategy. That's the strategy they're trading, right? So you give them your money and they'll trade it for you. So they do the buying and selling, so you don't have to, because it's hard. I know it's hard. Of course it's hard, but we've always had to do, that's how you've had to do it. But now you don't have to anymore, because there's people out there who'll do it for you. And that's cool. All right. So now this is the recovery of Tesla. And you're like, well, I was in Tesla, not in Tesla. I didn't get that recovery. TSLY. I was in TSLY. And so look at my Tesla. It just went sideways. Yes, but look at the purple line. You made all that money. They took it and gave it to you as income. All right. So this is Tesla. Had you, and this is the dividends that you would have made if you just spend the dividends way up here. So the gain, the NAV, right? Your account on your little app in your little track and trade program or wherever you did your investing showed that you lost 33%. Did you really lose 33%? No. Why? Because you had the yield that came in at 83%. Because they traded options for you and they collected all those options premiums. And you had 83%. Because you use the option strategy where they have leverage, not the shares, which is what we've traditionally done, right? $500 for the shares. Remember? Go pull it up one more time so you can see. Right? This is the example. Right here. Go into our open positions. So these two top ones, this is what they're doing. TSLY is doing this, top two. And everybody else has always done this. Buy and hold is $395. Trade the options, $6,000. So what happened is this is the shares, the $500. This is the options profit. Right? You get it? Okay, so the gain, your shares lost 33%. Oh no, I lost 33%. But the yield, the options made 83%. Oh, I like 83%. That's good. Can't get that down at Cache Valley Bank. So you take the yield and subtract it from the gain, you get gain plus yield, you get a 49% return. 49% return. That's a lot of money. A lot of money. It's a lot of money. You go down to Cache Valley Bank, say, I want a CD at 49% return. No. Where are you going to find 49% return? You're going to go open up a Subway sandwich shop, get you a retail trading, get you a job, you think you're going to make 49% running Subway sandwich franchise? Hell no. You're like if you can make 10, 12% on a Subway sandwich franchise. What about a McDonald's franchise? You think you're going to make 49% return going and opening up a McDonald's franchise? Hell no. Not in a million years. McDonald's guy, the guy that owns a McDonald's franchise doesn't make 49% return on his money, and he's got to manage employees. And he's got to worry about customers coming to his store. He's got to worry about freezer burn on his hamburgers. He's got to worry about lettuce that goes bad. He's got all kinds of problems. French fry oil that he's got to throw away somewhere in a landfill. Got to pay to do that. Nobody wants to take your French fries oil for free. Go pour it on the neighbor's yard across the street. Think how long you can get away with that? All right. Well, I'm going to start my own software engineering firm. Well, I can tell you from personal experience, that's a dumb idea. Who in their right mind would ever do that? All right. It's tough out there. Getting 49% return on your money anywhere, any kind of job. I'm going to go do it in real estate. You know how much money I get in real estate? I ain't getting no 49% return on my real estate. And I got a lot of stupid real estate. I hate real estate. Not now that I got this. Why would I had a slip and fall. Lady fell and cracked her head. I got to go deal with that. Got the lawyers, got the other tenants that I got to deal with. I got one tenant got bit by a spider. Now what am I going to do? Oh my gosh, I got to tell you this story. Brown recluse. We got those out here in the wild, wild west. And one of my tenants got bit by a brown recluse. And oh my hell, I am telling you, I don't want to show you the pictures because they are so nasty, you'd throw up. Her leg has a hole in it that big. It's spider season, guys. You be very careful. They had professional cleaners come in and cleaning their office. This is in my office building. And they had professional cleaners come in and clean, but the cleaner lady didn't get down in the corners, didn't go down behind the computers, just kind of lazy, just kind of did the quick little thing, dust a little here, push the vacuum around, and left all the corners full of little, dust mites. And under her desk, she was sitting at her desk and she had a computer, and behind her computer was a big nest of brown recluses. And one come out, bit her on the leg. And man, the hole in her leg is that big. And they got a pump on her now that's wrapped up, that's trying to suck all the goo out. Oh, she's going to lose her leg or her life. She's going to lose her leg. They said they're talking about amputating. It's nasty. It's spider season around here, guys. You be careful, those brown recluses. That's real estate. That's what you have to deal with. Lawnmower man got to come. Got the snow you got to remove. Got the roof. I got all the oh my gosh. I got so many problems with those things that catch water. What are those things? Rain gutters. They get full of leaves and then they leak out all over the place and then they get plugged and you have to have people come and unplug them. That's real estate. You want to make 49%? No, I'm lucky if I can get 12%. I'm not, with all the expenses, the things that I've had, so the slip and falls and all the stuff, I'm down to and then taxes. Oh my gosh. Property taxes. I paid it was like $10,000 in property taxes. And they keep raising it. It's gone up from when I first bought that building, which was like was like $4,000, $5,000, $6,000 in property taxes. Now it's like over $10,000 in property taxes. You think my rent goes up that fast? No. You start pushing rent up, guys start yelling and screaming, we're moving out. You think you could make that money in real estate? You guys? Oh my hell. These things are nasty, man. I'm telling you, these brown recluses are nasty. Nasty. Go look them up on the internet and look at pictures of people who got bit by brown recluse. And we have them all over here. They're pretty common here in the wild west. Ugh. Ugh. Go look at brown recluse on Google. Not right now. Wait till after class. But anyway, I'm trying to tell you, just trying to make a little bit of a comparison between what's out there and what's available to us. If we can get smart about it, learn, spend a little bit of time. I'm going to go ahead and, break your arm, patting yourself on the back because you're here in class, you're learning this really hard stuff. Is it hard stuff? Yeah, it's kind of hard stuff. I mean, you have to learn gain and yield. You have to do add. You have to add this and subtract that, and then it gets a bigger number. And if this bigger number is, you want the biggest number possible, right? Now, but it's past performance. Past performance not necessarily indicative of future results, but it's the best we got. So, well, hey, Tesla's been providing a 49% return. Well, that's pretty damn good. I'm going to put Tesla into my account. Now, am I going to put 100% of everything I got into TSLY? Probably not. We want to do a little diversification, right? We want to be a little bit of diversified. We want some of these really high return ones, which like this one is really high return. Well, we want that in our portfolio, but it's going to have a lot of movement up and down. So we want to kind of stabilize it with some that don't have quite so much movement. Now, what are some that don't have quite so much movement in them? Ulti's a good one. 49% return. Well, but it's diversified. It's getting 49% return. Look at that. 49, 33 on the gain, which is just go side. That's what you want. You want these markets to just kind of show this little sideways thing. That's the perfect one because the gain is just kind of, it went down. This is the 33% loss here. This was no loss here. So if you just go back 6 months on this thing, it's 40. Well, it's still 49%, but it's kind of maintaining even through that big last nasty move, right? So 1 year, but that's a good one. What's the one? What's the one? Mags, MAGS, right? YMAGS. So this one here is the Magnificent Seven, right? This is the seven big nasties. This is Apple, Amazon, Netflix, Google, Tesla, Nvidia, and Meta. I think are the seven. And so see, this one here is not so much. See the gain right here, the NAV was down 18%, but the yield was 46% for a 27% return. You're like, well, I don't want 27% return. That sucks. It's still double what I'm getting on my real estate, and it sucks. It's double what I'm getting on my real estate, and it sucks. You're like, I don't want 27. That's not good enough. Okay. I can't get that on my real estate. Oh my hell. But you put this one into your portfolio and it's going to bring your overall price down, right? So your overall gain down, but it's going to stabilize it. It's not going to have quite so much movement up and down. That's what this is, standard deviation and maximum range. So standard deviation is it's going to move about 11%, and the max that it's ever moved is 34%. Okay, and then that's what the yield is. The yield is 48%. The yield deviation is 41%. So it has a little bit of movement. Yield max range is 86%. So it still moves a little bit. I mean, from the top to the bottom, right? That's kind of an 86% range. But it pays out weekly. This is a weekly payout. Whereas Tesla, go and look at it, and it's a monthly payout. And it gives you a 27% return, but it's weekly payout, so you can compound more quickly. You can compound you can compound your money 4 times a month instead of once a month. That's why when you go look at something like AT&T, right? AT&T, you're like, oh, well, AT&T is a stock that gives dividends 4.69%. Everybody's happy about that. And then you got the gain, though. The gain is 30%. That's if this market really runs like it did, and that gives you a 35% return. That little 4% bonus is what you can get, and that's AT&T. The reason we use that as an example is because AT&T is in one of the top 10 yield producers in the entire stock market. I think Verizon is a little higher. Is it VZ? I think VZ, Verizon. Yeah, see, Verizon has a 6.58% return. But look at but Verizon's gain. Look, Verizon didn't go anywhere, down 3%. So they only have 3.36% overall. Because Verizon didn't go anywhere, because you're relying all on their gain, not on their yield. So if the gain's down and you have this 80% yield, the yield can cover the losses if the market has a down day. That's why I say they lose money more slowly than they gain. All right, this little chart right here is just like pure magic. You know, you can't find this little chart anywhere else on the entire internet. We had to build it. We had to make this chart so that we could do this for ourselves. We made the software for ourselves, and then we decided, well, because Lan, my dumbass, been selling software my whole life. I told my son, well, let's make the software for ourselves, but then we can sell it. What a stupid mistake. No, I'm not a stupid mistake. I'm just kidding. I like to sell software. I like to help guys. I'm here. I'm doing this for free. You're getting all this for free. Helping you learn all this stuff. Now you have to pay for Portfolio Matrix, a whopping $25 a month. But look at all the work it does for you. So the idea is that you can come in and look at all these things, and you can find your list. You can find your list, and you can have anything you want, any stocks you want. You can make your list whatever you want. I like to use these high yield funds that use options to trade with. And so I like to come in here, and that's where we come back over and we go into our performance here, and we have all the stocks that we've decided we want into our portfolio like that, right? And then this little tool comes in, and we say we want to go combine yield plus gain, which is what we've just been looking at, right? Gain plus yield, and apply that to my portfolio and my UBI portfolio right here. And it tells me what percentage I should be putting in each one of my different stocks. And you're like, and then you can come in here and you can do this. You can come in here and say, well, what if I didn't have HUI in there? What would it do to my portfolio? You right click on it and say remove. Or exclude. You can say exclude. You don't have to remove it. You can just exclude it from the calculation, and then this will recalculate. Now, if you tell them, well, how much money you got, let's say I've got $1 million in my account, and this month I got let's say I got 40,000. Let's just do an even 50,000. $50,000 in dividends that come out of it. 50,000. I'm going to put my 50,000 back in. Where am I going to put it? Well, apply that, and not only the percentage, it tells you the dollar amounts and where to put your $50,000. Lan, I don't have $50,000 to put in. I've only got a $10,000 account. Okay, well, let's say you got $1,000. Let's say you got $500. $500 in dividends. You put that in there, $500, and apply that, and it tells you where to put your $500 against those. You're going to put $31 in Nvidia. You're going to put $53 in Tesla, $37 in Coney, and it's going to maintain those high returns of right now. It's calculating your gain plus your yield at 63% combined, all those portfolios together. So, right, you're going to go out and you look at each one individually, and you're going to choose them. You're going to say, I like this one, I like this one, I like this one. You're going to write them all down on a little piece of paper like this. You're going to say that, and then you're going to create a portfolio. You're going to start putting your money into them, and then this little program tells you how to distribute the money. Each time you get a distribution, each time you want to put some money into them, it tells you where to put the money to maintain that gain plus yield of 63%. Takes all the guesswork out. Now, it doesn't mean you can't still come over and do your accumulation distribution models and look at these things and say, okay, well, I got to come down to my portfolio and I want to see what I got going. Should we be getting money into BITO? If you don't want any money in BITO, or if you do want to put any money in BITO, then you can either exclude it out of your portfolio, not put any money into it, exclude it, and say, well, I don't want to put any money into BITO, or BITO's down in the zone where I want to be buying it. I want to put my money into. So you can go through your little list and do your accumulation distribution model, and you can say, oh, well, BITO's in the accumulation stage, so I want to put that one in. But I'm looking right now over here at HUD. And HUD is so high, I don't want to be putting money into that. But I want to hold it in my portfolio. Doesn't mean I don't want it in my portfolio. I do, because, man, look at 53% return. Right? But I don't want to be putting any more money into it right now. It's a little bit too high. I'll wait for it to pull back, and then I'll include it in my my distribution. So then you come over here and you say, well, in HOI, I want to exclude that one right now. So I'm going to just exclude it from my list. It's going to take it out. Now I don't have HOI in there. I can hit apply my $500 and it will tell you don't put any money in HOI. And it'll tell you where to put the money elsewhere. So you pick the ones you want to put your money into out of your portfolio, and then you remove the ones you don't want to put money into. Oh, I don't want to put money into, they're all NVIDIA. It's too high. Exclude that one. And then doesn't mean you're taking it out of your portfolio. It just means you're not adding more money to it. And then you exclude that. Now it's telling you where to put your $500. I'm going to put some, let's see. NVIDIA. Oh, that's NVDA. I got NVDA. We got to exclude that one too. So exclude NVDA. Okay, so now NVDA and NVDY are both gone out of my portfolio. And now this is telling me where to put my $500 to maintain that 66% return gain, which is what I'm shooting for. Because last year, my portfolio did about 44% return. And that's a lot of money. 44% return on a $500,000 investment. That's what brought me up to almost $1 million, right? Brought me up to $1 million. I made $1 million in the last 18 months. Or not, I didn't make $1 million. I turned $500 into $1 million in 18 months. That's a good return. About 44% return is what I got. Now, I'm looking at this little program here, and it's saying, Lan, if you would have done this, you'd be up closer to 66% return, and you'd have a diversification across 12 stocks. And I'm like, oh, wow, that's pretty cool. So that's why I'm doing a rebalance. But the problem is I rebalanced too quickly. I didn't have this little tool. All right, I have it now. Didn't have it when I started. So I can do rebalancing this way. And it's magic, man. It's so cool. All right. That's the mistakes I made. And you can see them in my portfolio. I mean, you go over to my portfolio. Let's include, well, that's just NVIDIA. And this is the HOI. Let's include, let's put these back in. And this one here, include. And then let's just go back over to my portfolio with my UBI portfolio, open positions. And you can see, this is where I did my rebalance right here. Look at the difference since I've rebalanced though. This is where I did my rebalance here. This is the gain, this is the equity, right? So I'm down, but I'm up. So this is way outperforming what I went down. That's the whole idea, right? Just it's exactly my portfolio. This is what we're seeing now. We're seeing how my portfolio performed as if it were this chart right here. Right? Does that make sense? So this here, you got the gain of minus 33%, which is the blue line. And then you got the purple line, which was up 83% on TSLY in particular for a total of a prof of 49% return. So when you add the two together, you get 49% return. So when I go over to my performance, right, on my account, that's what I'm seeing. I'm seeing the downside on this one, and I'm seeing the upside on this one. And this one is far out exceeding the downside on this one. This is how much I lost. This is how much I gained. This is what you're going to see on your brokerage account. This is all the brokerage account shows you, which is, again, why we had to create this software, because they don't show you this chart right here. This chart does not exist in your brokerage account. I don't care who it is. No, nobody does it. You don't do it in Fidelity. They don't have it in Track and Trade doesn't have it in their brokerage firm. Tradier, you don't have it in Robinhood. You don't have it in any of them. I don't care. None of them do this. You don't have this chart right here. That's why we had to create this software, because these things are only 2 years old, right? These companies that do this kind of stuff. Not that dividends are longer and older. And there's been companies that have been doing a little bit of options trading on dividends, JEPI and JEPQ, but not like this. Not like I showed you. Not like this, right? Not like this. Not like the Bed Bath & Beyond. Or not Bed Bath & Beyond. Blueberry, whatever it was called. Not like the Blueberry example. So this is what I'm making. So this is where I did my rebalance. All right. And I tried to do all my rebalance at once. I should have done my rebalance a little slower. That's all I'm saying. Don't rebalance your entire portfolio and all at once. A tiny portfolio is not going to hurt, but if you start getting a bigger portfolio, try and rebalance a little bit more slowly, which is what these guys do, right? They're rebalancing their portfolios, which is what causes this pattern right here. That's what this whole thing is all about. It's how they rebalance their portfolios to make more money. They're just in a constant state of balance and rebalance. And that's what causes these trends, and that's what we capitalize on. We try to reverse engineer what the big boys are doing. And so now you come down here and you can see some of these break evens. This is really cool. These numbers I'm going to go through. We'll go through them when we got more time. I'll show them to you in greater detail. But this right here, you can see that I'm up right now. This is 1 year. Let's do. This is just my UBI portfolio. It doesn't include my other. We could do my whole portfolio. I just want to do this one UBI portfolio. You can see this one UBI portfolio is up $229 so far this year. So I've made almost $300,000 on just this one portfolio, and I got 2 more. So we could do all of them together. I got to click this one, and it would show you the total for all of them right there. But right now, just my UBI portfolio, what I call my universal basic income portfolio, this is not the tax, this is not the Roth or the traditional IRA. This is just this one here. I'm up $229,000 in dividends. Now you have to subtract my if I want to realize it, I can subtract some of my that's the tax loss harvesting. So I have some NAV losses, right? Some NAV losses, but I'm realizing all this gain. I can live off that gain. I don't have to ever realize that NAV loss if I don't want to. But what happens is it comes to the end of the year and I have $300,000 in profit. I can sell some of this NAV to cover some of that for tax purposes and not have to pay as many taxes. That's what I'm trying to do right now. That's why I'm doing a rebalance, because I've made so damn much money. I made almost $400,000. Now I don't have to. I've made $300,000 in here. See, because the others are in my RRAs, and since they're in my RRAs, I don't have to pay taxes on them. So I don't have to sell off my NAV to realize my NAV to cover my losses or to cover my gains, so I don't have to pay taxes on them. I don't have to ever realize those gains those losses if I don't want to. But I want to. I want to realize some of them so that I don't have to pay taxes. See how that works? It's so cool. You can choose when you want to realize your losses so that you can play it against your gains so that you don't have to pay taxes. And it's just a paper tiger. You don't have to really ever realize it if you don't want to. It's called tax loss harvesting. Go search it on Grok. He'll tell you all about what tax loss harvesting is and how it's done. But that's how you do it. That's how you do it in this program. All right. That's how we're going to do it. And it's so cool. All right, guys. I think I've run my mouth long enough, and just get excited and want to tell you all this really neat stuff all at once. And we need to really break it up into more classes instead of trying to just unload it all on you at once. But I got so much to show you and so much to tell you. And it's just so exciting. And I can't wait to get the next step. We're going to come through and we'll do it next Tuesday. Next Tuesday morning at 8 o'clock in the morning, bright and early. We're going to come and do it again. All right. And we'll go through some of this stuff even more in greater detail. I'll show you some more stuff. We got some updates coming out to the Portfolio Matrix software that I'm excited to show you. We're constantly working on it. We just hired a new programmer. So we're going to get some more stuff coming out. And if you guys want to join and be a part of Portfolio Matrix, we're going to start having live once a week. We're going to get together for everybody who has Portfolio Matrix. We're going to have webinars together. All right. We got that planned, and we're going to get that going for people who are members of Portfolio Matrix. So you go buy that. And then we're going to have our own private little sessions with just our Portfolio Matrix people. And we're going to do that in a Zoom meeting. Go-to meetings, Zoom meetings, so we can talk back and forth. So it's not like here on YouTube where I just do all the talking and you guys, the most you can do is put out a little tweeter here or there. You're going to actually be able to communicate with us in the meetings with our Portfolio Matrix. So if you want to be a part of that and learn all that stuff, come and join us there. We're going to talk specifically about how to get your accounts in and how to run all this stuff and what each report means. And you're going to ask questions, and it's going to be so much fun. I love that kind of stuff. I mean, this is where I get my thrill. This is my recreation and entertainment, and of course, it's also where we make money. It's always fun when you're making money, and making $229,000 a year is a lot of fun. A lot of fun. It's fun to make that much money. All right, guys, I'm going to let you go. Should we play around just a little bit longer? Some of you are hanging around. You want to see some of our AI stuff, right? Let's play with AI.
Hey, Land Turner here. I got a hot stock market tip for you. Subscribe to Pitt News Magazine. You can thank me later.
Yeah, that one. Also, this is really a fun one.
Yeah, of course. I have a lot of subscriptions for magazines. My most recent subscription, I picked up a lifetime subscription to Pitt News Magazine as an example, among others as well.
Yeah, when I heard Elon talking about Pitt News Magazine, I called in and got a lifetime subscription, myself, of course.
We would never use AI to get celebrity endorsements for Pitt News Magazine. Never do it. Never do it. Here, let's give you, I always hesitate to put this one up, but Claire, she keeps insisting. Here we go.
Okay, quick question. Are you subscribed to Pitt News Magazine yet? No? Really? Then what are you even doing with your life? Here's the deal. Pitt News on Air is like the espresso shot. Quick, a little chaotic, and probably too much of me. But Pitt News Magazine? That's the full latte with oat milk, cinnamon, and that fancy latte art you pretend not to care about. Subscribe to Pitt News Magazine at pittnews.com. Because if you like hearing me panic about Fibonacci levels, wait until you read what the pros are actually writing. And don't forget to follow my weekly podcast, Pitt News on Air, where we take the best of the magazine and bring it straight into your ears. Do it now. Seriously. Because if you don't, Mr. Turner says I have to come to your house and personally explain options trading, and nobody wants that.
She has pretty green eyes, doesn't she? It's a cartoon, guys. It's a cartoon. I know, it's a cartoon. Did you see the pretty green eyes? I know, not one of you saw her pretty green eyes. Okay, here, we got to do this funny one.
The other day I was sitting at my trading desk here in Sedona. The sun coming up over the red rocks. My betta fish, I named Delta, was floating perfectly still, as if he was watching the screen over my shoulder. I had a synthetic long position on, and it was finally paying off, up double digits. I sat there staring at the numbers, wondering if I should just take the money and run, or hang on a little longer and hope for more. The classic trader's dilemma. While I was thinking it over, my phone buzzed. It was Claire. She wrote, "Riley says you should cash out before you jinx it. Riley's her cat." I rolled my eyes and texted back, "Tell Riley I'll cash out when he can explain gamma risk to me. That's the kind of thing I write about every month for Pitt News Magazine." The daily struggle is real, even for someone like me, who's been at this for over a decade. If you want to read more about what trading really feels like and maybe pick up a few tips along the way, check out pittnews.com and subscribe. We're all just trying to make the right call, one trade at a time.
All right, let's play enough with AI. Here's the software I use.
Okay, this is the software I use. It's called Track and Trade. They've got two versions, one for stocks, one for futures. This is the website, trade.com. This is where you download a free 2-week trial. No credit card required. Okay, go download your copy, then come back here, follow along, and I'll show you all my settings.
All right, guys, I think we played with AI enough. We can go now. This is a lot of fun class. I hope you guys are enjoying it and having fun and learning something. And I'm not here to tell you what to do. I'm just here to tell you what I'm doing. And what I'm doing is having a lot of fun. I'm having a lot of fun. And again, like I said, it's a lot of fun to make $229,000 in 1 year. Trading. That's good fun. All right, guys. I'm just here to show you how I'm doing it, so maybe you can do it too. And we'll catch you next Tuesday morning, 8 o'clock. We'll do it again. All right? We'll do it again, 8 o'clock, bright and early. We're getting close to class. We're going to have classes down at the university here, third week in October. So if you're local, make sure you're signed up for that. We got a lot of people already signed up, so we're going to have good classes. So get in there before the classes are full if you haven't signed up yet. All right, see you then.
All right, that wraps it up for today. If you got something out of this, do me a favor. Like the video, subscribe to the channel, and share it with someone else who's trading or learning.
Hey, don't forget to tell them to subscribe to Pitt News Magazine.
Oh yeah, definitely subscribe to Pitt News Magazine. You'll thank us later.